In this video, we're going to record why is cash important. So cash is crucial to the operation of every organization. Reason being that if there is a cash shortfall, then very necessary payments cannot be made on time. Suppliers will not be paid on time, interest payments will not be made, and due to this, the company might go into financial distress, and the bankruptcy costs related to that will be great. On the other side, if you think that, okay, so in order to avoid this shortfall, we should keep a lot of cash with uh, the business, and even that is not correct because businesses are made to earn money and not to just collect all of the cash and keep it. So if there is extra cash which is not required, that extra cash should also be invested at different avenues. If the business does not have the internal expansion plans, then that cash should either be paid to the shareholders in the form of dividend, or that cash should be invested. Now, this is tricky because over here you do not want the highest return, but you're looking for a combination of return and liquidity. So you do not want to have idle cash. You want to earn return from it, but at the same time, you want to make sure that if the business requires cash, it is available to them at the correct time. Therefore, usually treasurers, they uh, invest in the money market because money market has short-term instruments, so the cash will not be uh, placed at one place for a very long time and can be used for business purposes as well. So given the importance of cash, it is very important for every business to have some sort of a cash forecasting model. Like for example, over here you can see that this is a cash forecast, and over here we have the beginning cash balance, and it is a weekly cash update. And from here you can see these are the receipts and the name of each of the customer, and these are all projections. So they're going to project that what are the receipts going to be, and then you have uncollected invoices. So this is the total cash that the business will get. Similarly, you're also going to project the cash outflows. So you will might have to pay commission, insurance, rent. So these are the cash projections for some of the next coming weeks. And based on that, they have calculated what is going to be the net change in cash and what will be the ending cash balance. Now, if the business sees that at some week they are going to have a negative ending cash balance, that would mean that they are running out of cash, and they will then think where should they finance this deficiency from. So they have to be planned for any sort of shortfall that will come in the future. And similarly, if they can see that okay, we are accumulating too much extra cash, then they are going to think where can we invest that money in order to earn a good return. But it is very important for them to make sure that the uh, cash is available for the short, medium, or long-term investments as required. Now, cash forecasting model, as you go more ahead, more in the future, you can see that the accuracy of the forecast is going to decline. So over here, you have the forecast duration. Over here, you have the forecast variance. So as the months increase, as you go into the future, you can see that the variance of your cash forecast is going to increase, because it is very difficult for you to predict what is going to happen 8 months from now. So for this, there are three ways of projecting your cash balances so much future in time. One is to use the receipts and disbursement method, which is the one that we just used. The other one is to use short-term projections, and the third way is to use the modified budget. So whatever is the master budget of the whole company, you're going to follow that. Whatever are the future capital budgeting plans, inventory plans. But the thing to note over here is that it is the treasurer needs to keep in mind that the forecast, the more future it goes into time, the less accurate it is going to be. So how can the treasurer resolve this problem? For that, the treasury staff should regularly compare the forecasted and the actual results and work its way back. Okay, sorry. And work its way back through the underlying systems to determine what was the error, what was the issue, and correct that so that these kind of problems do not arise in the future. Now, this cash forecasting can be helped a lot because of the automation in cash forecasting. Now, this cash forecasting can actually be made more accurate and by the help of automation. A well-managed purchase order system and the accounting software packages really help in this regard because they can track the payments automatically, the customer accounts automatically. However, although the automation greatly helps in cash forecasting, still there may be a lot of unexpected expenses that the cash forecast will miss out. So even though even if you're using an automated system, you still need to keep in check for these unexpected expenses. The automation is great for recurring activities that keep on happening, but if something unexpected is happening, that has to be manually entered. Now we have already discussed cash forecasting, and actually your accounts receivable and your payables are not that difficult to predict. Compared to them, the inventory levels are more difficult because they may rise or decrease sporadically. One element of inventory forecasting that causes a lot of problem is the Bulwick effect. Now, in order to understand this Bulwick effect, let's take an example. So assume that there is a capacity shortage of products. Because of that, you give a notification to your customers that you cannot provide them with some of the products that they require. Now, because of that, your customers will want to stockpile and they might increase their future orders a lot. So you will get high future orders, and because of that, you will increase your business's capacity because you think that the demand has increased. But because your customers had already stockpiled and they had enough inventory, their demand is going to shrink now. Now you have an increased capacity, whereas your customers are demanding a lesser amount now. Because of that, you have extraordinary inventory levels with you. This is the bullwhip effect, and this is quite common with inventory because there might be seasonal effects as well. So maybe during some season, inventory increased and you increase your production capacity, but that was just a seasonal effect, and the inventory went down to the demand went down to the normal level once that seasonal effect had gone by. So now that you are aware about the bullwhip effect, how can one avoid this effect? The treasurer should monitor the issuance of any order allocation notices to customers and then see if there is a sudden order increase that occurs subsequent to the notice. So one thing that they should do is they should check the notice that they have sent to the customers. Is there any increase after that notice or not? By doing that, they can predict then what is the real order volume. Similarly, they should be aware of incremental jumps, or you could say seasonal jumps, and not increase their production capacity because of that. So they should look at the historical values and then plan accordingly. So the bullwhip effect can be solved just by proactive planning. Okay, so now we're going to see the procedural and control steps for cash forecast. First, a new spreadsheet is used, then you enter the new balances, so receivable, payables, capital expenditure, sales forecast, and so on. All of the balances are entered, and then you match the forecasted against the standard list that you used, and you match balances against the preceding forecast, and then you review for reasonableness. So you want to see that whether all of the assumptions that you have taken and all of the values that you're forecasting in the future, they look okay, and then you review and approve the forecast, and then you retain a copy, and then you issue the cash forecast. Now this does not stop over here. Once you have issued the cash forecast, then when the actual cash balance comes and the actual time comes, and you see how much was your cash forecast accurate, and then you look for errors, and then you try to make sure that that mistake does not happen in the future.